within New Zealand. I'm also the founder of InvestNow. It's fantastic to have a good mix of people along again. A lot of people joining today, where the topic is talking through growth funds that are a really big part of things like the KiwiSaver landscape. I know on InvestNow we have 8 different managers growth funds on the InvestNow KiwiSaver platform. More than 50% of all of the assets in the InvestNow KiwiSaver scheme are in growth funds, and many of our investors really exploit the benefits of the InvestNow KiwiSaver scheme by using more than one manager's growth funds, because we've got managers on there like the ones here today. We've got Chris DeLevo from Harbour, who runs their diversified products. Also, Michael Keneally from Pathfinder, big name in the ESG space. And we've got Jason Choi, who is a portfolio manager of InvestNow's own house brand funds, being the Foundation Series funds. Sitting alongside growth funds from these groups, we've also got funds from the likes of Milford, Mint, Smart Shares, just to name a few of the managers that make up those 8 growth funds. The real point of difference within the InvestNow KiwiSaver scheme is that whole ability to mix and match different managers' funds. You know, often in KiwiSaver, you're just restricted to using the providers whose like scheme it is, and you can only join one scheme at a time. The benefit with us is you can join our scheme and use funds from all of these different managers in one place. And so today, really, we're going around the houses, just checking in again to see how managers like Harbour and Pathfinder and Jason for Foundation Series have thought about constructing their portfolios. Certainly a real benefit that is one of those things within investment management is the benefit of manager diversification, of bringing together different managers' products. You can certainly get better risk-adjusted returns within your portfolio. Also, you get the diversification of having exposure to different ways of doing things, and really that mitigates the potential for your returns to be dominated by one manager, say, underperforming through a period. Equally, because of the way the InvestNow platform works, and also the fact that growth funds are sort of ready, built, go anywhere type funds, you can keep your life pretty simple while getting that diversification. You know, if you're investing across 2 or 3 growth funds, it's a pretty simple portfolio structure. It will keep its right asset allocation and things in accordance with the investor's objectives, as long as they have identified a growth fund's right for them. And so it's a pretty easy way to manage a portfolio for an investor, is to adopt that approach. So I thought, just to jump straight into it, by all means ask questions as we go along. Sometimes we answer them on the fly, just depending how easy they are. Other times we'll answer them at the end. But I thought I'd start with you, Chris, from Harbour, just to give us a bit of insight into the characteristics and features of the Harbour growth fund that's within the InvestNow KiwiSaver scheme.
Yeah, sure. Thanks, Anthony. And just, I suppose, just a minute, forgive me, just on who is Harbour, because I understand we're not a KiwiSaver provider in our own right, and probably not that prevalent in the retail investor space. We're a manager who manages $8.4 billion. A large amount of our clients are large institutions, ranging from sovereign wealth funds through to actually other KiwiSaver providers as well. Our growth portfolio aims to utilise the strength of our domestic team. So we've got a really big domestic team that runs both New Zealand fixed interest and cash and Australasian equities. And my goal is to combine the experience of our local team with best-in-class global investment managers such as T. Rowe Price, PIMCO, Bailey Gifford, and others. So the growth fund itself, 70% in growth assets. It's probably a little bit lower than your regulation growth fund has these days. We tend to look globally and very actively in the way that we manage assets. The thing with active management is, we've got a track record that goes back to our founding in 2009. You have good years, you have bad years, but once you weigh up those good and bad years, you should be left with a really good outcome at the end. And for example, in our growth fund, we had really strong years in 2019, 2020, but tougher years recently. And just covering kind of a few key things that we do within the fund. I said that we look globally, and what that means is that we actually look across both the large cap spectrum of markets, but also smaller companies as well. So you might have heard of the Magnificent Seven, the likes of Apple, Amazon, Meta, Alphabet, Tesla, and others. They make up a really large part of the global market, but we think there's great opportunities kind of across the investor spectrum. So yes, we're very active in our fund. We don't hold index funds to any great degree. Investors pay active fees. They ought to expect over the longer term outperformance to compensate them for those active fees. So I might hand back to you, Anthony, because we've got 3 managers to go through.
Yeah, and just for clarity there, Chris, just as to highlight, I was listening and hopefully I understood. You're saying that your domestic type assets are managed by your teams onshore here. So things like New Zealand shares, Australasian shares, fixed interest. With also offshore, though, you're using specialist manager like PIMCO for your global fixed interest, really utilising their expertise and skills within your portfolio. I think you mentioned T. Rowe Price sitting there for your global equity portfolios as well. You're the ringmaster in terms of bringing all that together, constructing your portfolio. So that's your job inside it.
Yeah, absolutely. Yeah, so the overall outcomes of the fund, all the diversified funds at Harbour falls on myself. But yeah, as you say, that is our attitude. And why we have that attitude is we think it's really tough to beat global benchmarks from New Zealand. And we really want to focus with our investment team, which is about 17 people or so. We really want to focus on really selecting the best investments in New Zealand and Australia, and leaving the global investing to a team like T. Rowe Price, who has 200 analysts around the world. It's really hard for us to replicate that exposure from New Zealand.
Yeah, cool. Okay, well, turning to you, Michael, in terms of Pathfinder, tell us a bit about Pathfinder and how you're managing portfolios in the context of explaining it around your growth portfolio as well.
Yeah, sure. And I guess it's helpful to kind of go back to the core investment philosophy. And I quite like to highlight a framework of thinking from Jeff Bezos, which was, often analysts like to talk about what's going to change, but he liked to flip it and say, well, what's not likely to change? And do people want slower delivery times? Do they want less choice? Do they want higher or lower prices? And so to bring it to what we do, we kind of start off by saying, well, are people, investors, consumers, regulators going to increasingly want to see businesses operate more sustainably, more ethically? And we think that's the case. So, starting with that philosophical lens, and then kind of how our brand is positioned in market, people, our average investor is 39 and has 39K. And, they've entrusted us with their nest egg to manage it through an ethical lens. And so that's essentially, first and foremost, how we approach building portfolios. Similar to Chris, he talks about you've got different levers within, you've got global fixed, you've got equities, which growth, and you've got fixed income. Those, we've got a similar setting. It's a bit more than 70%, as Chris alluded to. And then within that, we build portfolios, bit of a building block. way of thinking. So we take some trans-Tasman exposure, we take some global exposure, and we can dial those up and down within a framework. That constantly what we're trying to do is think about the megatrends, the things that we think aren't going to change, the things that we think are going to be constant, and that's a 5, 10, 20 year lens that we're thinking through. So that gives a little bit of color around kind of philosophically our starting point, and then how we kind of go about building our portfolios as we think about kind of what's the right global mix, what's the right trans-Tasman mix. Hopefully that adds a bit of color.
Yeah, and so a really big part of what you're doing now is that whole ESG type filter that you're putting over all of the portfolios, or the growth fund that you're building as well.
Yeah, so as a big part of what we do with the thematic thinking, and we kind of stand back and go, well, what are those key megatrends? And we think of, we've kind of put them into 5 buckets: healthy planet, healthy living, deglobalization, digitalization, and social license to operate. And so as we think about, and then we think about how to express those investments into the funds, then we think about how to build portfolios. So we put a thematic investment layer in, and then we think about how to use a bit of quant to create or engineer the right level of risk in each of those different buckets, the global bucket and the trans-Tasman bucket. So for example, for the healthy planet, a great example that we like to talk to is the decarbonisation trend. Many governments have stated their long-term commitments to reduce their reliance on fossil fuels. So we've got First Solar. First Solar is a leading solar business in the US. Vestas is one. Long Road Energy, Brookfield Renewable Energy Corp. Those are ways to try and capture the benefit of the structural tailwind towards decarbonisation. In our healthy living bucket, we've got businesses like Nike, Lululemon, circularity in the form of Veolia and Cleanaway. Deglobalization is quite an interesting topic, especially if you're watching kind of the tensions around TSMC in Taiwan. So there we're really talking about a great way to explain how we're thinking about that is the semiconductor investments that we've got. So the world's increasingly creating two supply chains effectively. So we've got investments across that suite. ASML, Lars Research, Applied Materials, digitalization. We've got a lot of data center investments, and social license to operate. So this is the kind of thing where we're applying our ethical lens across everything that we do. And there's some good examples around, say, money laundering. We didn't own the casinos, Crown, Star, Sky City. We looked at it and thought, hey, there's genuine risks to their business over time, and they can be quite messy to work through. So that's the kind of thing where we're kind of, asset type, business type, where we see risk that we don't want to have exposure to, not just through a business model point of view, but also through an ethical point of view, just the social harm around gambling, etc. So to give you a bit more color in terms of the ethical element of what we do, we use 500,000 data points in our screening process, and something like 37% of all of the companies in the universe flag for at least one of the items that we look to avoid as per our ethics policy. So it gives you a bit of color around kind of the themes and a bit of the structure around building portfolios, taking into account, and actioning our ethical views.
Yeah, no, cool. And I know Chris mentioned that they see themselves as being slightly more conservative, I guess, if that's the right word, within a growth portfolio. At about 70% of their growth portfolio is in shares and equities, so what we commonly call growth assets. What proportion of do you know, in terms of your growth fund, what proportion you are?
Yeah, it's 80-20.
So it's 80-20, yeah, which typically in my mind is more where we see growth portfolios. I know we had a question there before that I saw fly past, which was around the whole whether or not if you had a really long term, you'd have any bonds at all within your portfolio. Obviously, that's an individual preference thing. Some people might do that, and we've got the ability within InvestNow KiwiSaver scheme to be 100% equities. But typically with the growth portfolio, you see that 75-25, as Chris has said, 70-30 being equities to income assets, you're 80-20. So yeah, interesting just to see those different nuanced approaches. So Jason, you're the portfolio manager of a foundation series funds, which are the house brand InvestNow products. Why don't you talk through what the foundation series growth fund does in terms of its investment approach?
Yeah, thanks, Anthony. So, as Anthony's kind of mentioned, Foundation Series funds is really focused in on almost providing no nonsense investment exposure. So our main focus is on providing low costs and tax efficient and access to broader investment markets. So kind of think about simplicity, but almost just the pure investment side of it. None of the kind of social housing type stuff. It's just pure investment markets, everything you can get on a listed stock exchange. So the funds have grown quite well, especially within the InvestNow KiwiSaver scheme, just predominantly due to that low-cost passive exposure, which is quite a nice differentiator to some of the other options we have available in the schemes, such as Pathfinder and Harbor we have on the platform today. And that way you kind of get that benefit of manager diversification, which Anthony kind of highlighted before. You're not guaranteed that any one manager is always going to continuously outperform throughout every single cycle. So having a little bit of passive exposure could make a lot of sense depending on what your risk tolerance is looking like. So within the Foundation Series Growth Fund, our fixed interest assets are managed actively, predominantly through a global investment powerhouse in PIMCO, which is operated by the Harbor brand. And then our New Zealand global assets are predominantly passively or index managed. So we take a very kind of traditional approach, again, 80-20, similar to Pathfinder. And we've almost taken that approach based off the average of what the industry is doing. So if you almost look at the average KiwiSaver scheme, you'll see very similar types of allocations. So 80-20 across growth versus income, and then around 54 in global equities, around 26 in NZ, and then the rest would be a mixture of fixed interest, whether global or local, and a little bit of cash as well. So pretty straightforward and traditional, and that's why we've kind of designed it that way, so we keep the cost super low at just 37 basis.
Cool. I think you froze there for a second at the end, Jason, but that's all right. It was just you were highlighting that low-cost, passive type exposure. Do you know, Jason, roughly how many securities do you have exposure to through the growth fund? Can you remember? Have you counted recently? Unfair question probably on the fly, but you're a smart guy. Oh, I think he's frozen for a second. Hopefully his wife hasn't gone into labour because he's close to having a baby as well. But I know it's thousands. So inside of that, Michael, do you know Pathfinder in your growth portfolio? Have you got a rough idea how many securities you've got?
Yeah, it would be under 200.
Right. So concentrated, right? That's even though it sounds interesting, probably to a layperson, that's really concentrated for a growth portfolio. I know it's only about 0.5% per asset, but interesting, right?
Yeah, that's just on the equity side. And
right,
then so within the fixed income bucket, it's probably more like 70, 80?
Yeah.
70?
So you're getting up to nearly 300.
Yeah.
Chris, have you got a feel for how many securities you've got across your growth fund?
Yeah, it's about 400. Yeah, it's about 400. Right. And just to give people context, the MSCI All Country World Index, which is the index that is most commonly used within KiwiSaver, within the kind of index tracking community, that has about 3,000 stocks in it. So you can see how active managers, in taking an active position, aren't simply buying every stock available on the index, instead trying to concentrate on areas where we think we can add value for clients.
But there you're talking about 400 shares. You've probably got another 1,000 or more bonds on top of that, right? Because from my memory of a PIMCO product alone, that would have more than 1,000 securities inside it. Yeah,
PIMCO's got 980 issuers, something along those lines. And in New Zealand fixed income, it's about another 60 or so.
Yep.
I mean, it's tough with a bond portfolio because you're not just investing in one company per se. There's issuers coming out all the time, and it's it's not like an equity market where you can easily just go out and buy whatever you want on any particular day.
Plus, also you want to avoid impact of default risk. Not that often you see defaults in mainstream fixed interest portfolios, but the diversification mitigates against that. And Jason, just because you pop back up again, can you remember in terms of the growth portfolio for Foundation Series, roughly how many securities you've got exposure to?
Yeah, so across global equities, got around 1,500, and then, like you said, with that PIMCO one, we've got another 1,000. So we're looking at least around 2,500. So
Yeah.
very, very diversified.
Yeah, which really plays to the point that I made earlier on around manager diversification. In this call alone, you've got Michael with the Pathfinder team sitting there with quite concentrated high conviction portfolios through to that more indexed approach that the Foundation Series is taking. So you can really get a flavour for, there's no right or wrong answer to how you should manage your portfolio. There's just different approaches which are all equally interesting in themselves. I suppose turning back to you, Chris, in terms of sort of tilts and flavours and things that are happening within the market at the moment, are there any themes or stuff that you're looking at, short-term predictions on market performance, anything like that are resulting in your portfolio change, you making adjustments to your portfolio?
Yeah, so I think there's a few. Because if you look at markets overall at the moment, right, you look at valuations and you go, wow, that's really, really rich. So, the US index, we track it using percentile relative to its 20-year history, and the valuation of the US market currently is at its top decile. 8 out of the 11 sectors are trading at or near their top decile as well. So, on a broad-based level, markets seem really quite fully valued. But I think that hides some quite interesting things happening below the surface. So one is that large caps relative to small caps are near multi-decade lows valuation-wise. So I think that's extremely interesting. And we've got some exposure to smaller companies within the portfolio. I'm sure Michael will have something to add here, but what's happened within the clean energy complex in Europe, just around the rate sensitivity of solar companies and offshore wind in particular, I find that interesting too, because I think the structural case for those companies is extremely strong, and we're probably getting an opportunity to buy into them at kind of cyclical lows. So they're not well captured by market cap indices at the moment. So I find that an attractive area as well. And lastly, and just to add to the comment that was put on the chat earlier, just around bonds, the key thing that you want to take into account with bonds to think about the returns that you'll get in the future is your running yield. Okay, so what is the yield? What is the coupon that those bonds are paying you today? And this will be a benefit to people within Harbour, but also in the InvestNow funds who use the PIMCO strategy. That's yielding kind of 6.5% at the moment. So that means if rate curves stay where they are, you ought to get 6.5% through kind of the average duration period, which is about 6 years in that fund. Now, I think there's a really good case here to say that we could get some capital gain in bonds. And the reason for that is there is not a lot of rate cuts priced in to interest rate curves at the moment. But even if you don't think that we're going to get rate cuts anytime soon, I think the structural case for bonds is a lot better. You've got that high running yield, but on top of that, the market consensus has moved away from one where they expected a recession in the US to one where a recession is not expected. So bonds have the potential in a portfolio to provide really good downside protection at the moment. Now, the one caveat to that, of course, is the scenario that we saw in 2022. Bonds are a great portfolio hedge as long as inflation is not the problem. And, that is a very key caveat, because in 2022, we saw the rare occasion of bonds and equities falling exactly at the same time. So having a good amount of bonds in the portfolio at the moment makes sense to us from an insurance perspective. Growth shocks are shocks by definition. A shock is something you don't see coming. And at the moment, you're getting paid a sufficient amount to hold those bonds, and they're contributing to your overall portfolio return. So I'll hand back, so I can see Michael furiously writing something down. So we might have a debate on our hands.
Yeah. And I'm going to come back to you too, Chris, because there's some interesting stuff around valuations that I want to dig into with you, because I think putting some numbers and metrics around some of that stuff, you know, what you're paying for some of those, whatever they call them, the Magnificent Seven type stocks versus what you're paying for other sorts of companies at the moment is stuff that intrigues me. So I'll come back to that. And for another day, it's probably another whole session. But really, we'll dig into bonds and things, because I really think, you know, bonds are one of those things which are really interesting to me. You know, if you're getting a 6.5% running yield on your global fixed interest portfolio, you've got a duration of 7 years in there. I know pretty much mathematically that tells me you're going to get 6.5% return, you know, plus or minus a tiny little bit over the next 7 years. It just doesn't tell you what the pattern of that return will be through that 7-year period, which is the thing that people find really hard. And what you're alluding to is those bonds look pretty good value in most scenarios, yielding 6.5% right now to give you that sort of long-term return, right?
Yeah, I mean, and Anthony, there is, I mean, the only scenario is the one I painted where inflation is really persistent and keeps going up, and you get mark-to-market losses on your bond portfolio. That's possible. It's happened. It's happened very recently. So if you're in the camp of re-accelerating inflation, it is tougher to paint that picture. But we're not holding bonds at zero yields anymore. So, you know, absolutely. In 2020, got down to really low yields. There was little protection that bonds could offer, right? Because they could only fall so far. And at the time, we thought they could go negative, and they did go negative in many countries, you know, Switzerland, Sweden, Japan, as examples. So, yeah, bonds are interesting. They've been boring for quite some time. Now, you know, I think bonds are kind of back to put a catchy phrase out there.
Yeah, and I think we'll need a whole different session on that alone, because I know as soon as we open up on that whole topic, people get really excited in terms of, you know, some of the concepts behind it, because I think people do really struggle to understand bonds and how bond pricing works. So let's do that another session. We'll get you back again, Chris. But Michael, turning to you in terms of your portfolios, what sort of some of these themes that we're seeing, how are they translating to positioning in your portfolios as well? And if you can mention as well, in terms of both mainstream assets, some of the things you've done in private markets I find quite unique to Pathfinder, almost in the KiwiSaver space, and of interest as well.
Great. So building on some of the points around Chris, what Chris has brought up, you know, we've gone from that Tina, there is an alternative, to there are reasonable alternatives, which makes the tactical asset allocation around, you know, how much income versus growth assets you want slightly more interesting. You know, obviously 5 years ago when you couldn't get yield, it would have made that choice really difficult. And right now, as you've both pointed out, running yields are actually quite attractive, and so we've been looking to add duration for similar reasons. So I think that's just a super interesting point around, well, what does that mean for how you actually manage your asset allocation, given where current yields are. The one thing I just talked to on the Mag 7, you know, obviously they have dominated market returns, but they are materially higher growth and stronger margin, and obviously very resilient business models on aggregate. Obviously, you know, Tesla is under not doing so well at the minute. You know, how much of that cyclical versus structural, time will tell. You know, and when we've been thinking about, well, how do you add the right kind of, as this, arguably we have this kind of soft landing, stronger growth outcome in the US, that pick your language, how you want to describe it. Would there be a breadth, in terms of leadership, and what's the right way to express that in the fund? We also, it's just also worth pointing out that 41% of the Russell 2000 are currently losing money. So you don't want to go too small cap either. So you need to focus on quality, the right kind of quality, the right kind of valuations, the right kind of setups, etc. So I just think it's a really interesting topic, something we've talked a lot about. Then, yeah, obviously we do take a longer term view on our thematics. So we have, over the last 6 months, trimmed one of the solar companies that wasn't doing so well. We decided to exit that position, in particular, some of the weakness in the residential space in the US, SolarEdge, we decided to exit. But we've held, some of your other positions, and like your Vestas, and we're considering adding another one, and one of the developers. And it's to that point around, 5 years, 10 years from now, are the unit economics of those businesses going to be more robust? And our view is that they will be. So we tend to take, pullbacks as an opportunity to add to positions rather than panic out. Talking to the private opportunity, it's quite interesting. We, if you kind of sit back and you think about we all want to have an impact. How do you think about impact? It's hard to have an impact in a liquid market sense, but in a private market sense, actually, empowering entrepreneurs to build something that, changes, has a positive impact on the world is a little bit more tangible, and it's quite exciting. And we've set a level of, say, 5% of the KiwiSaver funds that we might allocate to that sleeve, to the private investment sleeve. It's not just equity investments. There's a couple that are slightly unique. So we've got, for example, a few women livelihood bonds. These are really cool. They're listed in Singapore. They're basically loans to support microfinance businesses. And if anyone hasn't heard of what microfinance is, it's essentially loans to folk in poorer communities. And this particular enterprise tries to focus on empowering women entrepreneurs. And we love the intergenerational impact that you can have when you are helping support female entrepreneurs, especially where they're marginalized in their communities. And the women's livelihood bonds are really cool because it's kind of like, you get this credit enhancement from aid agencies that basically say, we will take the first bit of loss. And effectively what that means is that the underlying bond, therefore, pays a great yield relative to the risk that you're taking. So we love those and that we call that, part of our private liquid sleeve. We've also got, we support an entity called Positive Property. So this is a community housing story. And for those that aren't familiar, effectively there's 20-odd thousand families who are on a waiting list for emergency housing. I'm sure everyone's seen the headlines that, hotels in Rotorua are bursting at the seams with people that have nowhere to live. The Ministry of Housing and Urban Development effectively underwrites the cost of some of these products. So we effectively have lent money to a vehicle that is used to go purpose-build assets in order to help alleviate this social pain. And that's great. The economic terms for our investors are great. We like the contract structure. We like the pickup in yield. We also like the implicit government guarantee that comes with it. And we get to help build product for marginalized folk in the community. We also have invested in Lodestone. So Lodestone is a solar developer becoming a utility, effectively. They've got a very impressive management team. They effectively, what we liked about them and why we backed them, they essentially saw a great opportunity. New Zealand electricity wholesale prices are elevated, sending a signal, hey, market, build some generation supply. So what they get to do is go to large companies like the Warehouse Group and say, hey, we can produce electricity at this price and we'll give you that price over 10 years with some variation. Let's build the asset. Now that we've got the contract, we can go get the lending and build the asset. They can make mid-teens to high teens IRRs, which are great returns on invested capital. And we love the story because we're helping create a new competitor in the utility space with our modest investment. So we've just participated in the second raise last year to help them on their journey. We just got an update from them last night. Things are looking good, so we're very happy there. Then we've also got Sharesies. What we love about the story there is, what we love about what they're building is essentially a platform that democratizes access to what we live and breathe every day, investing and savings. This enables the younger generations to basically get a foot in the door to take control of their future, to take control of their finances. We love that. We love the fact that they've just really reduced the cost. I mean, a lot of advisors that we speak to who speak to the younger generations, vast majority of the younger generations will have a Sharesies account. And the cost equivalent, as I'm sure you all know, is very low. Like it's $5 to $20 a trade and to get the equivalent, you have to be dealing with quite large volumes with your typical brokers. So we love what Sharesies are doing, and we think that they've applied very sensible thinking and around how to build out a KiwiSaver product. They've applied, and really that management team have matured quite quickly into their roles, and we think they're building a great business. We measure that we are wary that with the private investment sleeve, whilst they're exciting, they have the great impact story. They're also liquid. There's also high risks. So we're quite wary about that, and we try to reflect that in our position sizing. So none of those private investments that we've talked about are more than 1% of the fund.
Yeah. No, certainly I talked to the team at the social housing thing that you're talking about, and it was a really fascinating area, that just because you're still getting a competitive return on your money, as you mentioned. So good to see the ability to do good, but have basically a thing with an implicit, I think it's an implicit government guarantee behind it, where you're getting a good return as well, which is interesting. So Jason, turning to you, why don't you talk about some of the refinements that you're looking at making to the Foundation Series Growth Fund, particularly I think within the global equity sector. From memory, you're looking at making a few changes there, right?
Yeah, thanks, Anthony. So, as we noted earlier, the Foundation Series is predominantly passive, so we're not trying to take an active management approach at all. So that means we're not trying to reinvent the wheel every time something hits the fan in markets, whether it's good or bad. So notwithstanding that, though, the funds are very popular amongst retail investors and really cater towards them. So we do tend to keep a pulse on what's happening in that retail investment space and any trends that are evolving out of that. So one thing that we are actively exploring at the moment within the Foundation Series diversified funds is adding an ESG lens to the funds, specifically the growth fund. So, and that we're doing so in a way that we're still ensuring that we're staying true to the Foundation Series kind of core proposition, which is still providing low cost tax efficient exposure. So the reason why we're looking at an ESG lens in the first place is that we recognize that everyday Kiwis are increasingly becoming more and more ESG conscious, and they would like to see that applied in their investments. So the Responsible Investment Association of Australia recently had a survey which noted that somewhere around 74% of Kiwis expect their investments to be managed ethically, and around 60% are willing to move their funds if investments don't align with their values. But the FMA has actually also recently released some research that showed that kind of 75% of these same Kiwis fail to walk the talk and actually select a fund that, or a manager that expresses these ethical considerations. So we perceive that this like a significant factor behind this like mismatch between kind of what people voice and what people actually do is a real cost premium with a lot of ESG funds out there, where essentially having that additional ESG overlay means a higher fee or a greenium associated with the fund. So I guess the analogy that we kind of like to use sometimes is that if you poll the average Kiwi on the street and you ask them, oh yeah, what do you think about doing right by the world and trying to reduce your carbon footprint? Everyone always enthusiastically nods like, yeah, of course, always trying to save the world. And then those same people go home when they're booking their flights to the New Zealand flights to the Gold Coast or whatever, and then ask you, oh, would you like to pay the extra couple of dollars to offset your carbon footprint? I would say most of them, end up don't doing anything, right? So even though it may be just a few cents or a couple of dollars, there is that mismatch there. So we reckon it's not that people don't actually care about ESG or don't care about the environment. It's just that they're not quite at that stage yet where they're willing to pay extra for it. So if we could somehow solve for providing this additional ESG benefit while keeping, the cost still super low, then we think there's a strong gap there, which is what we've aimed to do with the foundation series there. So within this ESG overlay, we're adding that, but still keeping the funds still super low cost at 37 basis points. And we're doing that by leveraging the global scale and expertise of the biggest manager in the world, BlackRock, and investing into their ESG kind of filtered solutions. So tax efficiency is still very important, so we're making sure that we do so and investing in like locally domiciled solutions, which means that you don't lose any of the additional tax credits you otherwise would when you invest into foreign equities. And we can touch on that if that doesn't make sense, but it's something that we at InvestNow always harp on about is being very mindful, not just the cost of the fund, but also how efficient it is in terms of tax structure, because equally that can be a drag on your returns, which is all the same to the investor. You're just losing out on, your hard-earned gains. Equally on the NZ shares side, we're looking to add an ESG overlay, and actually we've pinned Chris's own fund there from Harbour, the NZ Sustainable Shares Fund. So shout out to them. They've right up our alley in terms of keeping things super efficient in terms of cost-wise, but also very tax efficient as well with their ESG solution. So overall, we really believe that this could be a really great option for a lot of Kiwi investors, that they can almost have their cake and eat it too, in the sense that they get that additional kind of peace of mind, but still at the end of the day, we're still focused on providing broad market exposure that's still low cost and tax efficient.
Yeah, I've never heard that term before, greenium, so certainly it almost slid past me there. But yeah, so what you're saying is ESG filter onto the equities, the shares within the foundation series funds, it being the growth fund and the balance fund, but no additional costs. So that's something that you're sort of working through in terms of delivery. And I assume you're weeks away, months away, years away.
Yeah, so we're going to go live with this kind of new ESG approach in our upcoming high growth fund, which is kind of a few weeks away. And then after that, slowly transition the existing kind of growth fund into these ESG solutions. And we're not trying to be like, the next Pathfinder, almost being trailblazers in that kind of ethical investing space. Rather our ESG approach within the foundation series is largely centered on that kind of traditional negative screening or kind of exclusions approach. So, we'll invest into solutions that exclude stuff like tobacco, controversial weapons, nuclear weapons, civilian firearms, coal, fossil fuels, alcohol, adult entertainment. So we're not trying to almost pick stocks and be like, oh, this company is going to be the next leader. I'll defer to Michael on that of who is the next company in that space. But equally, you do still kind of get that peace of mind that you're reducing your carbon footprint while still kind of investing efficiently into the markets.
Yeah, and so which is again that really important thing for people to understand the differences of approach. Of, as I said, there's no right or wrong answer to that, but Pathfinder, you've got a manager who's clearly looking to exploit those trends, whereas you're saying you're just looking to avoid harm, basically, which is quite a different philosophy and approach inside it. No, cool. Probably go back to you, Chris, in terms of, I just wanted to unpick a couple of numbers around it. You sort of talked about global equities being really expensive. I forget what you said, 8 out of 10 or something. Like there were some indicators inside of there. It just skipped, never one for detail. When you talk about, I'm a simple person, right? Talk to me, even though it's a slightly complex issue, around price earnings ratios of some of the stocks that you see expensive, and then equally I want to talk about some of the things that are cheap out there in the same sort of context, and see if we can make some sense of that.
So price to earnings ratios, just for people viewing, I mean, they are one metric you can use to value a company. When we value companies, we look at a lot broader things, and we tend to focus more on cash flow measures as opposed to kind of pure earnings measures. But they do tend to be used just for broad market valuations. And their key limitation is that they either take the backward-looking earnings or the earnings for the next 12 months. So as Michael pointed out earlier, if you have a higher terminal growth rate in your business, it's not really a fair like-for-like comparison when you're saying, you know, Microsoft has a PE of, you know, call it 30, and a, you know, oil company has a price to earnings ratio of say 8 times, because Microsoft will probably have a lot higher terminal growth rate, which means its earnings are going up every year, which means its price to earnings ratio will fall, all things remaining constant, right? At the moment, the US market is quite expensive when we look globally, and part of the reason is because of the leading companies that they have globally around AI. So I suppose if you look at on a pros versus cons basis, I can tell you that overall market valuations in the US, which makes up 60 to 70% of the global market, depending on the index that you follow, they're high. So, you know, trailing earnings is around 23 times. Our data, which goes back to 1950, tells us that if you invest in the US market at a price to earnings ratio of above 21 times, your median forward 12-month return will be about 4.5%. So that tells you that typically investing at higher valuations does lead to below average returns more than a year out. It doesn't tell you what's going to happen in the next 3 months, 6 months, 9 months. I think that's really important too. There's that old saying that, you know, markets can remain irrational for longer, you can stay solvent. That's a saying for a reason. But I do think it's really interesting from the perspective of passive investors, because at the moment, you know, as a passive investor, you're investing in an increasingly concentrated market of the MSCI World Index. 20% of the index is in 7 companies, which only cover 3 sectors. So that's one of the kind of takeouts of it is, you know, if you are investing in the market, you're investing in these companies that have seen their market valuation increase substantially. The growth rates on the Magnificent Seven have been really, really strong. The numbers that we see from T. Rowe Price going into 2025 see their earnings moderate a little bit more. So they've had really strong growth based on a lot of companies rushing out and investing in AI. That's NVIDIA in particular. A lot of the companies have just managed costs really well. So a company like Meta has grown earnings substantially while shrinking their workforce by 25%. So a lot of these companies have become a lot more efficient. But what we're really interested in at the moment is kind of where this AI theme falls. It's a really early stage trend, if you want to call it a trend. AI, if you talk to the people in Silicon Valley, they'll tell you it's not yet commercialized. So there's a lot of spend going on in AI, but the rubber is yet to hit the road with regards to the business model and whether it will be profitable. So yeah, that makes the top end of the market really quite expensive on a price to earnings ratio basis. The smaller cap end of the market is cheap. But as Michael pointed out, sometimes things can be cheap for a reason. And one of the reasons that smaller caps are trading cheaper is that they tend to have more floating rate debt than fixed rate debt. So as interest rates have gone up, they have felt that more on their profit and loss statements than other companies. An additional thing to take into account is what Michael said about loss making. If you're a loss making company, you're living off the charity of strangers. So sooner or later, you're going to have to come to the market and raise capital. Well, a key trend that people might be really interested in is in 2022 and 2023, it has become really hard to raise capital. Why? Because Tina's left, as Michael talked about, used to be in there is no alternative. Now we've been introduced to Tara, and there are reasonable alternatives out there. So people don't want to just give away money to companies that aren't making a profit. I think notwithstanding those issues, I still think there are pockets of value within the small cap space. There are a lot of listed companies at the moment that are high growth, that are overlooked for a number of reasons. One is due to indexation. Indices, with more and more passive money in the market, it tends to go to mid and large caps as opposed to smalls. The other is the impact of higher interest rates has already been felt by those companies. So look, a lot to unpack there. I'll stop monopolizing the screen time and let you talk to the other panelists.
Yeah, no, interesting. There's probably nothing fascinating in when you sort of talk to, well, not nothing fascinating, but it's just interesting to note that, you know, if you've got price earnings ratios of, say, over 21 times, you're saying, then you observe that you get a market return from that point of about 4%. And it always intrigues me that it's a little bit intuitively obvious, I guess, because if you pay 21 times earnings, you're basically buying companies on a 5% yield. So at best, you'd sort of think in the long term, I'm going to get my yield the company's generating, provided profits don't shrink, plus growth of some sort. As you said, why those price earnings ratios can be a little bit intriguing is that what is that growth that you apply to it? You know, if it's company specific in a high growth company, it could be high for a long time. You know, is it just economic growth across a broad base of shares? You know, like how do you adjust for it? But the whole thing, if you pay a lot for companies, it tends to influence your future price, or your future return being low is what you're really saying. Whereas you're saying it's a dislocated market at the moment where you're paying a lot for some companies, but they're high growth companies, but not much for run-of-the-mill stocks, I think, Chris, in terms of what you're saying. It's a real game of haves and have-nots in terms of valuation, right?
Yep.
Like you can go and buy a boring old normal-looking company at a pretty compelling price, but there's that whole question: how do things like AI and future trends impact on that?
Yeah, I mean, Mike, I'm interested in your views just around where the valuations have gone on, you know, some of the clean energy, offshore wind companies. I mean, that's an area we look at and think, you know, that looks quite interesting on a structural basis, but the structural versus cyclical at the moment, and just this kind of anti-ESG kind of feel that we're getting out of the US and Europe kind of makes them quite an interesting area.
Yeah, I mean, as you alluded to earlier, Chris, the LCOE, which is the levelized cost of energy of different forms of generation, is ultimately, you know, what has been driving the increase in demand over the last 5-10 years. That in a lower interest rate environment, it's more economic. The IRRs are better. Geared IRRs are better when you deploy capital. When you have no marginal costs, it's all capital intensive upfront, and you have very limited marginal costs. That's your solar and your wind versus alternatives. But as you alluded to earlier, they are more sensitive to interest rate changes. So you've seen a number of offshore projects cancelled, and that's why guys like Ørsted, for those that are unfamiliar, they're a large developer of offshore wind farms and onshore as well. They've had to, you know, mark down expected profits materially, and also some of the wind turbine manufacturers have also booked rather significant losses, like Siemens Gamesa, GE Vernova. You know, they've all had a hard time, even Vestas, Nordics as well. So I'd love to see more offshore come online. I kind of look at it as, you know, it would be a plus if it does, and in terms of timing and quantum. I mean, there's some real structural dynamics that are holding back what's going on the west coast of the west coast of Australia, for example. If you haven't heard of it, look up the Jones Act. Odd Lots Bloomberg podcast is a great one that talks about some of these quirks that make developing these things extremely expensive. So I'm not very optimistic that some of those projects will prove economic. There's also, but I'm more interested in ongoing onshore, and we see value thinking about the core valuation of one of the wind companies that we own. It's more about the core onshore business with a potential upside if onshore comes back. And that's the base of our business case there, or investment thesis there.
Yeah, cool. Yeah, and I might bring things to a close here just because I'm conscious of time. I can feel myself getting hungry. But probably a key element of today is just to give people a real insight and flavour for how different managers approach managing their portfolios. And we've used, obviously, the backdrop of growth funds for that to sort of have a consistent theme in there. But the thing that we really want to celebrate and highlight is the different ways different managers approach it. Today we've heard from 3 quite distinct different managers in terms of their style, and in terms of Pathfinder with that real focus on thematics around ESG, industries of future coming into their portfolios. Equally, Chris with the Harbour team, that real focus on quality companies, what you're paying for them though in terms of valuation and price. Really fantastic to get that insight. Jason sitting alongside that with very much an index, low cost, tax efficient approach. Again, our whole theme is there's no right or wrong way to manage your money, as long as it's done professionally in a robust sense is probably the key vetting point to that. That's really celebrating different approaches and things, and you can get real benefits as an investor from diversifying your portfolio and having exposures to different managers within it, because sometimes one thing that's really good in terms of a market cycle, I think Chris acknowledged it, you will have times and cycles which favour one approach over another. And that's not to say your approach is wrong, it's just how this thing plays out. It's the whole reason the adage in the industry is, don't use performance or past performance as a reliable guide to the future, because it really tells you not a lot. I know questions, I think we've addressed them all. I know Harry, I think it was, asked, and exposure to things like India as a sector. Yep, certainly send us through those ideas. Jason's the right person. He's the one who ultimately vets what goes on to InvestNow. So if you're seeing good products and good investment ideas, put them on there. If there's managers here who think, who've attended and come along as audience who want their funds considered for InvestNow, just reach out to Jason and team and talk through it. But certainly thanks to the 3 of you for your time. And your insights as well. It's been really good. Michael, you didn't do too bad for a man who'd had to run down 32 floors because of a fire alarm. So I'm pleased you got over that. But no.
Yeah, luckily it turns out it was a false alarm.
Yeah, good. Yeah, no, okay. Well, we look forward to hosting people next time when we come up with the next forum that we run over the coming weeks.